Defining the modern unicorn beyond valuation. The term unicorn, initially coined by venture capitalist Aileen Lee in 2013, was intended to underscore the statistical rarity of privately held companies achieving a valuation exceeding $1 billion. This benchmark, while still central to the definition, now applies to a significantly larger cohort of companies. As of September 2024, the global count of such entities surpassed 1,400, a stark contrast to the mere 39 identified in 2013. This proliferation suggests a dynamic shift in the venture landscape, potentially fueled by increased capital availability over the past decade and the emergence of broader market opportunities. However, achieving unicorn status, particularly the $1 billion valuation, does not inherently guarantee long-term sustainable success or reflect robust underlying business fundamentals. Some market observers contend that unicorn valuations can be inflated, driven by speculation and future projections rather than current profitability. The intense pressure to achieve rapid expansion and secure a unicorn valuation may lead companies to prioritize short-term growth metrics, such as user acquisition numbers, over the creation of actual, enduring value. This introduces a crucial distinction that this report will explore. The difference between perceived value, often captured in a funding round's valuation, and the intrinsic, sustainable value that characterizes truly great companies. The path to enduring greatness transcends the mere attainment of a valuation milestone. The growth in unicorn numbers also correlates with technological advancements. A concept termed the unicorn software power law posits that the rate of unicorn creation tracks the growth of compute power, with projections suggesting approximately 1,400 US-based unicorns by 2033, assuming a more tempered 15% year-over-year growth rate. This underscores the significant role of technological innovation as a macro-level driver for the creation of high-value companies, a theme that will be further explored in the context of future trends. The dramatic increase in the number of unicorns, from a few dozen to over 1,000 in a decade, might not solely indicate that achieving billion-dollar status has become fundamentally easier. Instead, it could signal an environment characterized by increased market noise and, consequently, a higher threshold for genuine differentiation and long-term viability. This growth occurred during a period of historically low interest rates and abundant capital, the zero interest rate policy, ZIRP era. Such conditions may have contributed to valuation hype, leading to a greater number of papercorns, companies with high private valuations but unproven exit potential. Therefore, aspiring founders must exercise caution against pursuing valuation for its own sake. The anticipated thinning of the herd suggests that many entities currently holding unicorn status may not endure. True corporate greatness will ultimately be defined by more than achieving a $1 billion valuation within a specific, perhaps overly exuberant funding climate. There appears to be a growing emphasis on building a sustainable foundation as opposed to merely chasing the glamour of unicorn status. This may reflect a market correction or a maturation in the perspectives of both investors and founders. The focus could be shifting towards constructing resilient, profitable businesses rather than entities driven purely by aggressive and sometimes unsustainable growth. The previous era's mantra of growth at all costs, often associated with the pursuit of unicorn status, is likely undergoing reevaluation, particularly in light of declining capital efficiency metrics observed even among enterprise unicorns. Consequently, future unicorn builders will likely need to demonstrate not only rapid expansion, but also a clear and credible path to profitability and long-term value creation, making the journey potentially more rigorous in terms of business model validation and operational discipline.